Hi, this is Louis Novak, owner of Lower Rate Lending in downtown Mesa. Today, we're going to talk about APR, annual percentage rate. It kind of ties into my last topic of mortgage interest rate reporting, which I mentioned that today's reporting doesn't account for the cost of a rate, it's just the average note rate. Um, APR does account for the cost of an interest rate, and it was actually created uh, to basically allow consumers to shop across lenders and have an equal comparison of the cost of or the annual cost of an interest rate. So an APR or the APR is essentially the interest rate plus your upfront lender charges annualized as a percentage rate. So the fees that go into calculating the APR are going to be your upfront lender charges like points, broker fees, underwriting fees, administrative fees, processing fees, the per diem interest from the day you close to the end of the month. If it's a FHA loan, the upfront mortgage insurance. So they're essentially lender associated fees. Now, the fees like credit reports, appraisal fees, title fees, um, those will not go into that calculation. So we'll keep this simple. Just going to call it a fixed rate loan, and we'll actually calculate some APRs. Yeah, I challenge you to go ask your loan officer to calculate the APR for you manually. Guarantee you'll see deer in the headlight. Um, So we'll just say we have a $300,000 loan, 7% interest rate. Let's see how that looks. So I'll get my handy dandy mortgage calculator, the real estate master. Well, this one's version 3X. When I first got it, there was a real estate master, no versions. It was the first one. So it wasn't on a phone. And it was an actual calculator, a standalone calculator. So let's put it in here. We got a loan amount of 300,000, loan amount, 30-year term, 7% interest rate. That gives us a payment of 1995 and change. So let's say my APR fees came out to $5,000. So our actual finance loan amount, which is what the loan amount would be if we didn't have to account for fees, would be 295,000. So we got 295. New loan amount. We're keeping the payment the same, the 30-year term the same. What would that new interest rate be? So to get the same payment on $5,000 less loan amount, the rate would go up to 7.17. So that is the APR. So let's say my competitor down the street is charging you 15 grand in APR fees for that rate, for that 7% rate. So now our amount financed loan amount is 285. That interest rate would be 7.52. So there you go. That's how you calculate APR. So if someone was out shopping, they would see that my APR for a 7% rate would be 7.17. Competitor down the street, 7.52. You can compare. 7.17 is less, so it's a better deal. And that's the whole point behind APR is for a consumer to be able to shop across lenders and have um, a way where everybody reports it the same way. So if you have any questions, give me a call, DM me, email me. Uh, if you have any questions about anything about a loan or need a loan, give me a call. Lower rate lending, where lending is made fast and easy. Have a great day.